Hello, good evening, everyone. My name is Simon, and I'm the Chief Business Officer of MYTHEO. Welcome to MYTHEO Monthly Performance Review webinar. Thank you for joining us. Before we start, a quick introduction of MYTHEO. MYTHEO is an extension of Theo, the first, biggest, and the leading digital investment manager in Japan. MYTHEO was launched in 2019 and is an award-winning digital investment platform approved by the Securities Commission Malaysia. By leveraging on technology, MYTHEO offers you high-quality, personalized, affordable, and maintenance-free way to build your wealth. Our aim is to help you achieve your financial goal and enable your moments in life. Today, you'll be hearing from our Chief Investment Officer, MYTHEO Stuart-Box. We will be reviewing the performance of MYTHEO's portfolio for last month and what's the drivers behind them. Meanwhile, we will also discuss the portfolio optimizations that have taken place this month as we try to deliver high-quality, risk-adjusted return to our investors. If you would like to ask MYTHEO any questions, you can interact with us via the Q&A button on the menu bar at the bottom of the window in which this presentation is displayed. Without further ado, over to you, MYTHEO.
That's great. Thank you very much, Simon. And thank you, everybody, for joining. Let me just share my screen and get started. Okay, so welcome to the performance review for April 2022. I think what I'll try to do in our time today is explain a bit of the background for the performance over the last month or so. Explain a little bit about the rebalances that we've done with the portfolios, and maybe give some ideas about potential outlook for what the market might look like over the next 6 months or so. But if you do have any questions, as Simon said, please go ahead and put them in for us. I think it would be useful to answer any questions that you have. So let's start here. This is the normal slide showing the performance for the last month. This is in ringgits. And if we look at the three main portfolios and the satellite ESG portfolio, they were all negative during the last month. And year to date, we have the growth portfolio down 8.78%, the income portfolio down 5.43%, the inflation hedge portfolio is slightly positive, plus 8.87%, and the ESG portfolio down 10.34%. Just to put that in a little bit more context, compared to last year, we had very strong returns during 2021 across almost all of our portfolios. And still, since launch, all of our portfolios, all of the main portfolios are strongly positive. So the last month has been a tough month, I think, for many investors. But in terms of like the longer horizon, performance is still strong. Having said that, there was a series of concerns that are worrying almost all asset markets, equities, bonds, real assets as well. And as everybody knows, this is all tied into inflation and rising interest rates. And so last month, the Fed did start raising interest rates. That had impact on obviously bond markets, also equity markets as well, commodity markets, and we'll look at some of the specific securities there. And then, of course, the ongoing kind of geopolitical concerns to do with Russia and Ukraine weigh on risk sentiment in general, provide another layer of worry for a lot of investors. So it's been a bit difficult environment over the last month or so. But maybe if we look at some of the specific portfolios we'll be able to see a little bit more in detail. So let's start with the growth portfolio. So as I said, this was down 4.48% in the month. And just to recap, the goal of this portfolio is to achieve high long-term returns through exposure mostly to global equities. If we look at the current positioning of the fund in April, this is what it looks like. Each of the blocks on the pie chart here is an ETF that's included in our portfolio. So you can see the largest holdings in our portfolio are things like US large cap value with 21%, US large cap growth 20%, and then UK and so on. In terms of the performance last month, the biggest detractors really came from the US, in particular US large cap growth, mid cap growth. You can see down at the bottom there, the bottom three ETFs, QQQ, which is the NASDAQ ETF. This is large cap US growth down 13.6%, mid cap growth down 11%. These were the biggest drivers of the negative performance over the month. But as you can see, almost all markets were down in April. Things like frontier markets, emerging markets, China performed relatively better, certainly than the US, but they were all negative on the month. We've also seen a spike in volatility in equity markets. We've seen several days where, the US market has been down 3% one day and then rallies 3.3% the next day. These are big swings for like single day movements in US equities. And so it's clear that there's a lot of investors out there who are uncertain about how to react to the news that comes out. Having said that, underlying US economic data is not bad at all. The US economy seems to be holding up at the moment really rather well. If you look at things like job openings, employment, things like that, factory orders, things like that. Actually, the US economy so far seems to be holding up relatively well. US companies seem to be handling this spike in inflation relatively well. So at the moment, there's no sign of the US slipping into recession or anything like that. But it's clear that the actions of the Fed aiming at taming inflation do cause people concern whether the Fed can genuinely engineer a soft landing for the US economy. And because of that, sentiment swings one day to the next, and we see these relatively large movements in equity markets. But I think it's important to remember that as of right now, the underlying US economy is strong. Okay. We also, at the start of May, we did our regular reallocation within the growth portfolio. So we do this every 3 months, and this is part of the regular cycle of maintaining the growth portfolio. And what we do is we re-optimize the portfolio. We take in the most recent data, we run our model, and we re-optimize the portfolio. So we did this trade at the start of May, and I'd just like to share with you kind of the main movements that have happened as a result of this reallocation. So you can see a bunch of ETFs which we have included in the portfolio or raised the weight on them, and a group of ETFs that we have reduced the weight or taken out of the portfolio. And so in terms of the ETFs that we've taken out, you can see 2 European ETFs here, the Eurostoxx 50 and the MSCI Germany ETF. These are probably coming out of the portfolio from a model point of view, because the risk that we see in Europe, risk of volatility, the economic risk that we see in Europe has increased, and we've seen higher volatility in these ETFs over the last few months, and hence from a risk-adjusted point of view, they're less attractive. In terms of the other ones that we've exited, MSCI Taiwan, MSCI Singapore, and you can see on the other side, ETFs that we've included or added to are India and South Korea. And so our model is taking a slight rotation within its Asia positions. And I think what's happening is countries like India have actually come through relatively well over the last few months. The actual Indian stock market has a lot of exposure to financials and also to energy stocks, surprisingly. And these are both areas that benefit from higher commodity prices and higher interest rates. And so actually the Indian market is relatively robust in this current environment. Whereas markets like Singapore are very heavily real estate featured markets, and hence in a rising interest rate environment, these markets tend to be more volatile. So this is all part of our regular process of managing the portfolios. This was all part of the regular process. But as you can see, we've updated our growth portfolio and shifted it slightly in these kind of directions. Just to re-emphasize, we do a series of processes monthly, quarterly, and annually to maintain all of your portfolios. The one we're talking about at the moment is this one, the reallocation here, where we've been running the reallocation for the growth portfolio. This is all part of the regular cycle of maintenance for all of our MYTHEO clients. Let's move on to perhaps the income portfolio. And so this portfolio was down 0.62% in April. And just to recap, this is a portfolio that's designed to produce regular, stable levels of income with a lower level of volatility compared to something like the growth portfolio. And so naturally, this tends to be focused more on bonds, treasury bonds, corporate bonds, high-yielding dividend stocks, that kind of thing. If we look at how the portfolio is positioned at the moment, the pie chart here shows the individual ETFs that are included in the portfolio. And so you can see we've got a range of investment grade ETFs, high-yield ETFs, treasuries, US treasuries, international treasuries. So we've got a range of different kinds of bonds in the portfolio. Naturally, all bond markets are negatively impacted by inflation concerns and rising interest rates. But obviously the markets that are hit hardest tend to be government bonds, and in particular long-dated government bonds. And so you can see down there at the bottom where it shows the bottom 3 ETFs in the investment universe, the worst performing ETF during April was this long US Treasury bonds, 20+ year Treasury bonds, down 9.5% in the month. That's a big move. But as you can see, actually US Treasury bonds are not a huge part of the portfolio. We have a lot of other bonds, relatively shorter duration bonds, non-government bonds as well in there. That gave us a lot of, I think, a lot of diversification benefit in April. So given the environment, it was very difficult to get a positive return in April. We were down just over 0.6%. But I think given the overall interest rate environment, that's not a bad outcome, I think, for the month. Thirdly, we have the inflation hedge portfolio, which was down in April by 0.37%. And just to recap there, the goal of this portfolio is to protect the real value of the assets in the portfolio. And so this portfolio tends to be focused on real assets, things like real estate, commodities, gold, silver, oil, those kind of things. Things that will protect you in the case of inflation. So if we look at the contents of the portfolio at the moment, this portfolio has a large exposure to US real estate, 30%. It also owns a large amount of TIPS. So these are US bonds where the interest rate on the bond is linked to US inflation. So those are a very good hedge for inflation. But also things like gold, base metals, investment in infrastructure, things like that. In April, gold was a positive contributor for our portfolio. But things like gold, silver, base metals, real estate in a rising interest rate environment were all negative for us during April. Finally, if we turn to the ESG portfolio, so this was down 3.88% in the month. And the goal here is to provide high returns in the long term, with a similar level of risk to the global equity market, but focused on ESG companies. And so this portfolio only invests in ESG-based ETFs. Portfolio here is spread across right now 5 different ETFs. These are all regional ETFs, so EFA, emerging markets, US, and so on. And they're all ESG tilted. The performance here is very similar to the performance of the growth portfolio, which makes sense as they're both equity portfolios. And the biggest driver of the negative performance, similar to the growth portfolio, was US growth names. And so in the case of the ESG portfolio, this US mid-cap growth ESG ETF was down 12.6% on the month, which is a detractor for the portfolio. Similar to the growth portfolio, we did a regular reallocation of the global ESG portfolio. This slide summarizes the changes that we came out with from our model for the reallocation. And so we reduced the weight on 2 ETFs, the US SUSE ETF and the emerging market ESG ETF. We added a US large cap growth ETF and another US ESG ETF. And then we closed out of a new US mid-cap growth ETF. The drivers here are kind of similar to what we saw for the growth portfolio, in that a shift away from kind of mid-cap growth towards large cap growth generally has slightly lower volatility, but also a swap between some of the ESG ETFs within the US, trying to find slightly lower volatility ETFs. But again, this is simply part of the regular maintenance of the portfolios. So that's what I'd like to cover on in terms of the performance. I think maybe I'll hand it back to Simon, and maybe we can start looking for some questions.
Yeah, so thanks, Matt. We have a few questions here from our audience. So the first one, I think we can refer back to the ESG portfolio. So the question is about why there has been a sell-off on the NUMG, which is the large cap, if I'm not mistaken, NUMG, yeah, the mid cap, sorry, the ESG mid cap growth ETF and NULV. So that is a large cap ETF, value ETF. So I think the question is about why has there been a sell-off in these two ETF from the performance perspective?
Oh, right. So in terms of the performance of the actual ETFs themselves.
Yeah,
sure. I mean, if we think about the growth ETF in particular, for example, that kind of mid-cap growth ETF, these have been sold off heavily, not just ESG growth ETFs, but in general US growth ETFs, in particular kind of mid-cap, small cap as well, have been sold off heavily in the US. I think it's important to remember that this is a part of the market that has had very, very strong returns over the last 2 or 3 years, far higher than their long-run average returns. So there is an element of these things have simply got expensive. Rather than there being any particular news or particular reason why these things have to get sold off, they simply rose too fast over the last 2 or 3 years. People's expectations of some of these particular US growth stocks got extremely high. And so this kind of environment where there's an element of risk off, an element of risk aversion, it's natural that some of the ETFs that have done the best over the last 2 or 3 years get hit the hardest here. I don't think there's anything particularly deeper than that. I mean, you can look a little bit deeper and say, you know, if you think about the sectors that benefit in the current environment, well, those sectors are probably things like financials. Rising interest rates are good for banks, they're good for insurance companies. And those companies don't tend to be in growth ETFs. You know, the large financial companies don't tend to be growth stocks. And so these kind of growth ETFs have a relatively low exposure to sectors like finance, also to large energy stocks, things like that. Energy stocks tend not to be particular growth stocks. And so in the current environment of rising interest rates and higher commodity prices, those kind of sectors naturally don't tend to be very highly weighted within growth ETFs, I think.
Right. It does make sense that these are more volatile companies, right?
Yes.
That obviously will be more aggressively sold down during panics. So I think this question also pretty much carry on from the first question. How long does MYTHEO predict the current volatility to go on? And should investor like us move forward, should we place our fund into a more safer model like money market fund?
I mean, that's a very good question. So volatility itself is very difficult to predict. It's a function of underlying economic volatility plus the volatility of investor sentiment as well. And investor sentiment can swing very much. If we think about kind of what are the two big underlying sources of volatility right now, one is the outlook for, in particular, US economic growth, whether the Fed can tame inflation without causing a recession in the US. That's one big driver of underlying uncertainty and volatility. And then the second driver probably is geopolitical risk. What is going to happen to Russia and Ukraine? Is it going to just keep continuing? Is there a chance that it could grow in terms of the size of the conflict, that kind of thing? So there's an element of geopolitical uncertainty and economic uncertainty. In terms of the question, how long could this last? I would say in terms of the first question, it shouldn't last particularly long. It should become clear, certainly over the next 2 or 3 months, whether the Fed is going to be successful in taming inflation. And so we have inflation numbers in the US, I think, coming out today, US time.
Yep.
That could be the first indication of whether the Fed is making progress at the right kind of pace.
Yep.
But certainly within maybe 2 or 3 months, we'll have a bit more clarity about whether the Fed is going to be able to engineer this kind of soft landing. So that underlying economic uncertainty, certainly that question about the US, I don't see that lasting for a long period of time, 3 months, 4 months, something like that. On the geopolitical side, that's much harder to say. I'm not an expert in geopolitics at all, but simply by looking at the news and commentary, it's clear that there is a chance that the conflict in Ukraine will drag on for a longer period of time. Certainly right now, there isn't a clear exit course for that kind of conflict. Neither side seems to be looking to end the conflict anytime soon. And so that geopolitical risk is much, much harder to predict how long it could last. I don't have a good answer to that. What should you do, though, in cases of volatility? That's a very good question. There's a couple of things I think you can say is, one of the things in a period of volatility is don't try and time the market. So I think what part of the question was, should I go and sit in a money market fund until things settle down? And I can understand that's a very tempting kind of idea. You think, well, there's a lot of risk in the market right now, there's a lot of volatility. Why don't I just go and park my money somewhere else and wait until that volatility calms down? And that's a reasonable thing to do. I would say I would not recommend that as a general approach. I would recommend staying invested. For the simple reason that you don't know when, we don't know, nobody knows when this volatility is going to fade, when the market is going to rally. I mentioned earlier, we've seen days where the US market rallies 3% in a single day. And so it's clear, volatility could swing back onto a positive side quite quickly, and you could see quite a sharp rebound, especially given the fact that the US economy remains strong. And it's very easy to miss that rebound if you're sitting in cash, And so I wouldn't recommend that. I would recommend staying invested, using things like dollar cost averaging, adding gradually to your portfolio. Don't try and put in a large amount of money on a single day, just in case you pick a day that's very negative. Gradually put money into your portfolio. The best way is at kind of a regular interval, say a fixed amount every month. Then if the market's down, then actually what happens is the money that you put in buys you more in those kind of months. Dollar cost averaging, especially in periods when volatility is high, is a great way to build your portfolio and lower your actual experienced volatility.
Right.
The other thing I'd say is especially things like an equity portfolio, now is not the time, I think, to be taking kind of big active bets in an equity portfolio. It's very hard to predict how things are going to come out in terms of, individual sectors, individual companies, things like that. It's very hard right now to do that. The MYTHEO approach is to keep full exposure in the growth portfolio to equities, but spread that risk as broadly as possible across as many markets as possible, and build a portfolio that has equity exposure, but no unnecessary risks in there. And this reallocation that we did this month is part of that process, keeping you fully invested, fully exposed to equities, but trying to avoid as much unnecessary risk as possible. I think that's probably the best long-term way to deal with this kind of volatility.
I suppose staying invested is important, and more important is the asset, the rebalancing and the reallocation and optimization of the current portfolio, right? Yeah. So I saw the performance that you have shared just now. In terms of the April's performance, MYTHEO performance portfolio has managed to outperform the benchmark. So in fact, global equity fallen by over 6%. That is in dollar term. But if in ringgit, the benchmark has actually fallen by 4.68. So our growth portfolio has outperformed slightly on that case, and the income portfolio has outperformed a lot more than the benchmark. So likewise for ESG. So I think staying invested makes sense, and more important is that at MYTHEO we are able to rebalance, do the right thing to re-optimize to a low, more sensible, low volatile kind of investment. So that combination, I think for long term will be able to provide a good risk-adjusted return. Right.
I think that's a very good point about kind of portfolio maintenance. Yeah, that's a very good point. You know, in a period of volatility, it's very easy for your portfolio to drift away from its target allocations. And that can lead to some unexpected results in terms of risk and returns. And so something like MYTHEO, where you're automatically every month rebalance back to your long-run target, is a good way of kind of maintaining your portfolio, I think, certainly in this kind of market.
Yeah. Yeah, obviously the low fees does help as well in this environment versus our unit trust peers. So we move on to the third question. When do you foresee the market to reach back to its original peak, like the one we saw last year?
That's a very good question. Very good question. So if you think about where is it, I'll focus on perhaps the US market, because that's the one I know best. But if you think about like the US market, it's down about 20% from its peak, and it's now almost exactly at the same level it was 12 months ago. So all of this volatility, all of this downturn, all that's happened is it's simply given up the last 12 months of returns. We're flat over the last 12 months. And so the market's fallen a fair bit, but it's not like it's completely crashed or anything like that. How long do I think it would take to get back to that kind of level? That's a very difficult question. I think there's two things that would bring us back to that. One is this idea that there's no more interest rate surprises to come. You know, the Fed has been very good about signaling the interest rate rises. And they've been very clear that, you know, if they're raised at 50 basis points, but they're not going to go as far as raising it 75 basis points at a time, that kind of thing. So the signaling from the Fed has been very, very clear. And the pattern of interest rate rises that they predict over the next few quarters are well known, and they're essentially already priced into the market.
Right.
And so long as the Fed keeps on that kind of course, then I don't think there's any cause for any more volatility to come from the bond market. People have their expectations. So long as the Fed continues on a course that's pretty similar to those expectations, then I think perhaps, you know, we're coming towards the end of interest rate uncertainty in the US, especially if we see, you know, signs that inflation has at least peaked and perhaps is starting to fall. And then combine that with, you know, so long as the US economy remains on the same kind of robust course in terms of earnings, in terms of jobs, then it's perfectly possible that the market could rally really quite strongly in the second half of the year. But as I said, it's extremely difficult to time those kind of things. It's extremely different. I couldn't say, when this is likely to happen. But if you think about what's needed for that to happen, it's certainly not impossible that things could rally strongly over the next 6-12 months, certainly.
Yeah. So perhaps probably one of the driver that we are looking at today could be the corporate earnings, right?
Sure.
What can we learn from the US and Europe corporate earnings season so far?
Yeah, sure. So US earnings season is winding down at the moment, and it's been a very good earnings season, I think, for the US. If you look at most people look at the element of surprise in terms of earnings growth relative to consensus, relative to what people were expecting earnings growth. And the surprise over the course of this earnings season was just under 10%. So earnings came in just under 10% stronger than people were expecting.
Mm.
And so what this is showing is that, the underlying US economy remains strong.
Mm.
But B, it's also showing that this inflation is being passed on by the companies to the underlying consumers.
Mm.
And so obviously, inflation raises the costs for companies.
Yeah.
And if they had not been able to pass those costs on to consumers, then their profits would have been squeezed. And I think that's what people were worried about in the US. But it's clear, certainly on the evidence so far, that US companies have been remarkably good at passing those increased costs on to consumers. And I think that's reassured a lot of people in the US, a lot of equity investors in the US, that although too much inflation is a negative thing, it's negative for consumer sentiment, all that kind of thing. It's not necessarily a disaster for corporate profits.
Mm.
So that's the US. The European earnings season is still running, but it's getting towards the end there. Actually, Europe earnings has also been stronger than expected.
Mm-hmm.
I think people had relatively low expectations in Europe, given things like the exposure to Russian energy, that kind of thing.
Mm-hmm.
But again, in Europe, earnings have come out remarkably resilient. Again, a surprise relative to consensus of over 10% in European corporate earnings. And so it seems, at least on the face of corporate profitability, that companies are still in good shape. Corporate earnings are still robust and growing strongly and growing faster than people expected.
Well, that's good to know that. I mean, the corporate are doing well. The fundamentals are intact for companies. Okay, so we probably move on to this question, which is related to the currency, right? So, the portfolio return has also been contributed by a weaker ringgit or a stronger dollar. Right? So ringgit has depreciated by over 3% against the dollar in April. Is the US dollar likely to peak after the latest Fed policy decision?
Yeah, that's a very good question. Yes. So I think it's important to note that it's not so much the ringgit is weak. It's more that the dollar is strong, as you mentioned. And so the dollar has appreciated against most currencies over the last 3-4 months. In some cases by a large amount. Whether it's peaked or not does come down to the outlook for US interest rates. So 10-year treasuries are now over 3% in terms of their interest rate. And so there is an argument by some people that over the next couple of months, maybe even with the announcement today, we're going to see US inflation peak out. In which case the worries people have about even faster interest rate rises in the US should fade. And in that kind of scenario, you could well see US dollar strength fading a little bit over the next few months. I think that's a perfectly reasonable scenario. Having said that, currency markets are extremely difficult to predict. There's a lot of the volume of transactions within the currency markets are so large that it's very difficult to predict simply on the basis of interest rate differentials or economics like that. There's a lot of other factors that drive it. But I think certainly, there's a decent chance that we've seen, at least in the near term, at least a pause or perhaps a slight pullback in US dollar strength, given kind of the outlook for inflation in the US.
Sure. So, so there's this question from our audience: will inflation persist through 2023, as the latest CPI reading is at 8.3%? So I think so the question is whether we are going to see high inflation level persist through next year.
So if we think about like the biggest underlying drivers of inflation right now, both in the US, also in Malaysia, in most countries, the biggest component of inflation right now has been the rise in energy prices. It doesn't account for all of the inflation, but it's the biggest single component of inflation rises. And so if you're asking, is inflation going to be persistent, you've got to come back and think about, like, is the oil price going to remain as strong as it is? Is it going to go even higher? That's a very tough one to predict. It's clear, the conflict in Ukraine is not going to go away soon or quickly, and the kind of sanctions on Russia in terms of their energy exports look likely to remain, or maybe even get tougher. It looks like Europe is going to try and get off Russian energy completely, and so that takes a big chunk of supply out of the energy market. We've talked in the past of the fact that, global energy demand has recovered strongly after the pandemic, but global energy supply, even before the Russia events, was below its pre-pandemic peak. And so we already had an imbalance within the energy market. And now the sanctions against Russia is taking out a large chunk of energy from the supply side. So the question is, how quickly can countries like Europe switch to other areas of other sources of energy? Those are not easy things to do quickly. Having said that, there are certainly countries that are capable of raising output. A lot of OPEC countries, a lot of Middle Eastern countries are quite capable of raising their output, certainly in the medium term. And so if you think that the energy market is going to stabilize, supply is going to come back a little bit, that supply-demand imbalance get a little bit smaller, then I think that would take away one of the biggest drivers of inflation. The other drivers of inflation are things to do with, supply chain, things like that, which should gradually ease themselves. Those things are not long-term drivers of inflation. Obviously, that depends a little bit on the course of the pandemic, and lockdowns in China are not going to help supply chains. But you could imagine that those supply chain issues are unlikely to be long-term things. So my personal expectation is that this inflation is not going to be long-term persistent, simply because the underlying drivers of them don't seem to me to be structural. they're temporary drivers of inflation. But that's a personal opinion, I think.
Sure, great. So we have one question. So this question is pertaining to the portfolio allocation. So given the current climate, if I have got a 30 years horizon, what would be a suggested way to gear my MYTHEO portfolio between growth and inflation fund? I'm keen to maintain my income portion to the minimal level, given that I treat my EPF as my income or stable exposure. So any thought?
Yes. So if you have a 30-year horizon, well, that's number one. That's a very good position to be in. To have an investment horizon like that is a very good position to be in, because, to be honest, over a 30-year horizon, the kind of worries that we've been talking about for the last hour or so are almost certainly irrelevant over a 30-year horizon. When you look back over 30 years, the kind of volatility we've seen over the last month, you won't even notice it on the graph.
Right.
And so if you have that kind of horizon, then I don't want to give specific percentage allocations. I can't give specific recommendations to individuals. But if you have a long-term horizon, then a relatively high allocation to the growth portfolio is a very good position to be in. And that's what our allocation algorithm will give you. If you are relatively young, if you have a long investment horizon, naturally our allocation algorithm will tilt you towards growth relative to inflation hedge.
Yeah. And we have seen market survive many major events, right, in the past. So 30 years would be a very long horizon to navigate or to smoothen out all those major events.
Exactly. Yes. Yeah.
So I would put my money in growth portfolio if I have 30 years in my investment horizon.
Yes.
But I think just follow whatever the algorithm is suggesting, because that will be the best recommendation, for your circumstances.
Yes.
Yeah. Okay. So maybe I can do a wrap up here, since there's no more question. So yeah. So I just recap what Matthew has shared. So basically, the implication of further US Fed interest rate hike to curb a rising inflation will continue to pose uncertainties to the financial market. And it's really challenging to try to time the market, especially in such time as this. Panic selling is a very common investor misstep. History tends to repeat itself, and market have survived events such as this in the past. Investors are generally rewarded to spend time in the market versus trying to time the market. So the tips to navigate the market uncertainties is through asset allocation, portfolio diversification, and dollar cost averaging. This will help to reduce risk associated with investing and potentially earn more consistent return over time. And at MYTHEO, we remain confident and convinced that the most effective investment method is to invest with a long-term perspective through a diversified MYTHEO Omakase portfolio of growth, income, and inflation hedge portfolio. So that concludes the session for tonight, or for this evening. I would like to thank Matthew and also everyone who have dialed in this evening to hear from us directly. So this will be our regular affair. So we'll be having this every month. Do join us again next month as we talk about our performance for this month. We'll be having another webinar next week on discretionary portfolio. So we hope to see you in that webinar, and also we hope that everyone can stay safe and take care. Thank you. Good night.
Let's take a moment to talk about money. We all know how important it is to save. But no matter how hard we work to build our nest egg, experts believe most of us still won't have enough to retire comfortably. Investing is the better way to grow your wealth, but requires years to master on your own, or high fees and starting capital to hire a wealth manager. Now, there's an easier way for you to invest. MYTHEO is a digital investment manager that does the work for you using investment strategies with a proven track record, helping over 60,000 Japanese investors grow their wealth. That's over $300 million of assets under management. And this is all it takes to start investing meaningfully. When you create an account, MYTHEO will want to know you a little better. Things like your age, assets, and appetite for risk. Once it has collected enough information, a professional investment portfolio will be generated just for you. This portfolio will consist of ETFs listed in the US stock market. Each ETF is selected for its different feature, such as country or asset class, to further diversify your portfolio, and that disperses some of the risk. This global diversification strategy is one way MYTHEO optimizes your portfolio. The algorithm that drives MYTHEO's logical investment reasoning is based on the research behind 2 Nobel Prizes. In the past, you or your fund manager would have to closely monitor the market's various moving parts every day. That's a lot of data and decision-making. With MYTHEO, you don't have to sweat the hard stuff. It automatically rebalances your portfolio to its prime investment position. What MYTHEO does for your portfolio is no secret. View the rebalancing data anytime from your account, accessible via the app or website. You might even want to start calling the shots one day. Go ahead and adjust the portfolio to suit your needs. After all the money talk, here comes the money talk. Thankfully, MYTHEO's service will not break the bank, just a small fraction of your investment. With no sales fee, no exchange commission, and not a single surprise charge. So the question to ask yourself is this: will it be worth it? Deciding to invest may mean new commitments and lifestyle adjustments. It could also mean the freedom to do what you've always wanted, not just life's milestones like marriage, kids, and retirement, but the moments in between that make life richer. Whatever it looks like, it's time to invest in experiences that truly matter to you, because life's moments are priceless.